Welcome to ForexTV.com. Today's Friday, February 13th. I'm Tim Kelly with your New York Forex Market Buzz. The dollar is gaining against the yen, down against the euro as markets await the U.S. House vote on the stimulus package, which is expected to pass with enough votes from the Democratic majority. Now let's go to the latest headlines from the CEP news desk. Two major U.S. banks have announced they will halt foreclosures after coming under intense pressure from U.S. politicians on Wednesday to do something to help the U.S. citizens weather the financial crisis. Citigroup announced it would be halting foreclosures starting February 12th. The bank will uphold its commitment until U.S. President Barack Obama has finalized details of his plan to modify mortgage loans to benefit U.S. residents at risk of losing their home. Minutes later, J.P. Morgan announced it would also put a moratorium on foreclosures for a 3-week period or until March 6th. Bank of America CEO Ken Lewis already announced a similar pledge earlier this week in a hearing before the House Financial Services Committee. Consumer spirits are breaking down to new lows, the result of the Reuters University of Michigan Consumer Sentiment Index, which dropped 5 points mid-month to 56.2 versus January's 61.2. Expectations, the leading component of the index dropped to 49.1 for nearly a 9-point loss, a sizable loss that points to a run of disappointment ahead. One-year inflation expectations suddenly eased as they did in December, down 0.6 to 1.6%. Less expensive gas prices, under $2 in most areas, may be one reason for the decline. But another reason may be a widening outlook that the economy looks to be weak for some time to come. There was no significant reaction to the report, at least initially in the markets. Here to talk to us about all these events today, we're joined by Greg Salvaggio, currency trader at Tempus Consulting. Greg, welcome to the program.
Thanks for having me.
Hey Greg, we had some news out. It was a busy news day. Not only Michigan consumer sentiment, but earlier out of Europe we had GDP for Eurozone, and in that component was Germany. Very disappointing. Markets seem to have shrugged that off. The Michigan news seemed to have shrugged that off too. Is there any news that's going to affect these markets until we are through this stimulus and bailout plan?
We don't believe that right now the market is clearly focused on this dual approach that the Obama administration is taking. First, obviously, the stimulus, which in all likelihood will be passed this afternoon, barring some unforeseen events in either the Senate or the House, and then signed into law next week. I think after this, though, the market's focus is really going to be on what is Geithner's bank TARP 3, TARP 4 plan, whatever you might call it, and how is that going to affect the mortgage market, the home foreclosure market, and ultimately the banks and what's forced upon them to lend. And the idea is that hopefully that credit market conditions will then eventually begin to ease, lending occurs again, and the economy starts to climb out of this deep, deep recession that it's in.
Well, Greg, let's talk a little bit about today's event. It's widely expected that the Democrats have enough votes to pass this bill. After it's announced, what do you suppose the market reaction is going to be? Are we just going to keep going along? Is it going to be a bump? It's
priced in. It's priced in. There's no surprise. I mean, we got a little bit of a relief rally in equities the other day when it was announced that the three musketeers came over from the Republican side and are going to sign it. The House certainly has enough votes to pass it, and now the Senate does with these three other senators. So it's no surprise at all. This is a foregone conclusion that the stimulus passes. This $780 billion bill passes. So we don't believe that there's going to be really any effect on the market at all today with this.
That's pretty widely held view right now. Greg, let me ask you this: we're trading in pretty narrow ranges, pretty much drifting along sideways. Not much movement in the currency markets. What do you suppose, and when do you suppose this gridlock breaks?
Well, what we've been advising our clients is that we're pretty much range bound in sideways trade in all likelihood through the remainder of this month, trading 2 or 3 cents, either side of 130 on the euro, 2 or 3 yen either side of 90, and sterling finding some base around this 143 level. And the reason that we say that is it's very difficult for anyone to make any decisions about investing or reintroducing some limited risk to their balance sheet until we see what Part 2 of the Obama economic rescue plan is. Once that's in place, once that's approved by Congress, then you could say, okay, how does the U.S. stack up next to the other G7 nations? You know, you brought up the point about Europe and the Eurozone. Our belief is that the Eurozone is poised for some significant hardship this year. We think the inflexible policy stance of the ECB is now going to come and bite them, and we're looking for really a prolonged economic slowdown throughout the Eurozone that we think is ultimately going to lead the dollar significantly higher the remainder of this year. We're targeting a 110 euro at year end, really predicated on that belief that Eurozone interest rates will remain low for a while, the recession will be far deeper seated than it was in the U.S., and at the same time the U.S. will be climbing out of its economic problems third to fourth quarter of this year. So we're very, very bullish on the dollar for the remainder of this year. We just have to get through this little period of where the Obama administration puts forth these economic policies and proposals.
And that you talked about euro. What are your thoughts on sterling right now? That's a big mover and a big question mark right now because the UK is probably in worse situation than the eurozone, although it's a little bit more complex in the eurozone. What's your take on sterling?
We think sterling will, in all likelihood, remain offered for the remainder of the year, really for 3 reasons. You look at the 3 main industries which have been driving economic growth in the UK over the past several years, and each one of them is under some serious duress. First, we have the financial services sector, which clearly provides a much bigger GDP influence in the UK. That's been all but decimated now with the semi-nationalization of most of the banks in the UK. Real estate, another huge component of their GDP. Their housing market, much like ours, has collapsed. Then the final area, which has provided some additional GDP growth, has been oil, particularly out of the North Sea. With oil prices sub $40, that industry is now suffering. So we think that the UK is going to be under serious duress, have a long-term economic problems. It's going to keep sterling depressed for quite a while. However, having said that, we think the Bank of England is going to actively manage sterling through intervention levels sub 135.
Well, let's move on to, at this point, let's move on to, thanks for your insights on sterling. Let's move on to yen. A lot of folks are talking about intervention. Seems to be a prevailing thought that we're going to see a little bit of a dollar strength against the yen in the intermediate, maybe short term.
Well, we think really what's happened is the yen has become this this surrogate for risk aversion. And the reason being simply is because of the lost decade, Japanese banks had extremely limited exposure to mortgage-backed securities and CDOs. So their balance sheets, in a sense, are much stronger than those of their Western counterparts. As a result, investors sought the safety of yen assets. However, having said that, Japanese interest rates are at 0.3% right now. We're seeing the crux of their economy driven by exports. Now, you look at companies like Sony, Toyota, Honda. They've budgeted dollar-yen levels at 105, 110 for this year. Their GDP is going to be absolutely decimated on exchange rate conversion and the slowing global economy. So our view is that dollar-yen can push significantly higher. We're also targeting a 110 year-end level for dollar-yen, predicated on 2 things. First of all, risk aversion will eventually end. Investors will look to shift assets from the safety of yen holdings to places elsewhere in the world, we believe primarily in the United States. In addition, the Japanese economy is going to suffer and slow significantly throughout 2009. We're already seeing unemployment levels raise to heights not seen in Japan really post-Second World War. They really have never pulled themselves out of this deflationary cycle that they've been in really since the early 1990s. So, as a basis of that, the yen's benefit, we believe, will soon go away, and it's going to result in not really the carry trade again, but certainly an aversion for yen assets.
Well, Greg, I really appreciate your insights. You make a compelling case. I'm compelled to go and buy dollar against the yen right now, as a matter of fact.
We think it's a good trade, and we also think that the BOJ is going to defend the 87 level with a vengeance. We believe between 85 and 87 there is a very serious wall that the Japanese officials will put in place, and the primary reason is Sony and Honda and Toyota cannot survive with dollar yen at 85 or dollar yen at 80. It's just not possible. The industries will be decimated.
Well, I think that's a good place to leave it off there, Greg. Thank you again for joining us. Appreciate your insights today.
Sure thing. Take care.
This has been thanks, Greg. This has been your New York Forex Market Buzz with Greg Salvaggio of Tempus Consulting. I'm Tim Kelly. Join us later this afternoon for PM Exchange right here on ForexTV.com.